So I've been in the industry and with Highlands specifically for almost 10 years. October is my 10-year anniversary.
That's awesome.
I love it. I feel like it's not very common that people stay on the same platform in real estate. They bounce around a lot, and I understand why, because I don't know about you, but I get a lot of recruiting calls.
All the time.
But I love my platform so much. Like the leadership down, everything is just, it's a really healthy place to work, and I feel very well supported, and the people really care about each other, and it's a good place to be. But I got started, it's kind of I don't know, I pivoted hard right in my 20s. I was working for a medical device company out of college.
Wow.
And doing different sales and marketing roles, and I loved it. It was very type A, and they had a lot of upward mobility, and I would call myself a ladder climber, very competitive, was always looking for my next, like, what role am I going to get to do next, because I liked that. And I never thought that what I learned there could translate into, like, any type of finance, right? Very different roles, but a lot of it transferred over because they poured in so much to me, and the products were so complex that I had to find ways to communicate simply based on the audience how it benefited them and how it worked. And so that translated over far easier than I thought it would to what I do, because a lot of people are intimidated by mortgage. But my mom's been in mortgage for 30 years.
Okay.
So that's really the only reason I even considered it as a position for me, is because people don't talk about that in college. They don't talk about real estate or finance, like mortgage lending finance, as an attractive career choice, and it's incredibly attractive. I wish they had more of that available, as options for college kids so that they could start younger, because I feel like one of the interesting things about at least the mortgage side, I feel like it's less prominent on the realtor side, but for lenders, they're all a lot older. Just generally speaking, there aren't very many 20-something and 30-something-year-old lenders.
Right.
But so I went through my 20s with this medical device company, and then when my husband and I decided we want to start having kids, I was flying at least every other week all over the country.
Yeah.
There was always an open suitcase in the bedroom, and I was just like, I'm not sure that this is sustainable if I want to be a present mom. So I kind of made... I prayed a lot, thought about it a lot, and finally called my mom and was like, I know you love what you do, but tell me why. And we started that conversation, and it just, I'm pretty headstrong. She was like, you should probably start, at a entry role where you can learn the ropes, understand how it all works, process files. And I was like, no, I want to hit the ground running. It's sink or swim, and I'm either meant to do this or I'm not. And so I just started out as a loan officer from day one, and that is a hard way to do this job. But I learned so much, and she was obviously a phenomenal mentor. She knows everything. She's brilliant. And here I am 10 years later, and I definitely feel like this was a calling for me. I love it, and I get to empower people, and it fills my cup. So that's kind of high level how I got to where I am.
When you were growing up, was there a good work-life balance from your parent, like with your mom being in the industry?
She's going to watch this. So, yes, I liked that she was able to come to all of my games when I was in high school and I was playing basketball and volleyball. She never missed anything. It's hard sometimes to have boundaries in what we do, like for the phone, because people always need something, and most people are buying homes, as you know, on nights and weekends because they're at work when we're at work. So it takes more practice and more, building your own boundaries. But I'm fortunate at this stage to have built pretty healthy boundaries. And, when I was starting out, I was scared if I didn't answer somebody at 9 p.m., they're going to leave and find somebody else who will. Very rarely is that the case.
Yeah.
So I think watching my mom do it when I was younger and then figuring it out for myself, my life changed before and after kids, and the needs and my parameters changed, and I've got great clients that understand, and a lot of people are in the same stage of life, so they're pretty understanding. So yeah, I think I've struck about as good a work-life balance as I can, and it was modeled for me, and so.
Well, I mean, I just know it because it was interesting. You said they don't talk about really. When we were at B&I the other day. you look at all the categories that are there. None of those are really talked about. Anything that touches real estate, from contracting, roofing, lending,
Right.
real estate, realtors, like that. These are all trades that people can pursue, and it's not talked about in school.
No,
I think the education
and they're
system,
lucrative,
and they're
you can,
very lucrative.
build your own schedule. Yeah,
I mean, they're
exactly.
entrepreneurial, right? So I think, but I think that the system's designed to push people to college, and then college, but whatever. I'm not going to get into that. But so talk about how because I think with lending it's very similar to real estate. You have to grow a client base.
Yes.
So you have to advertise yourself. You have to prove you know what you're doing.
Yes.
So how are you able to do that?
Good question. Now I'm at a point in my career where my reputation has built itself. So I've got a very wonderful, loyal base of realtors that like working with me and see the value that I provide their clients. I don't pay for any marketing at this stage. When I was young, I think I spent more money than I made because I was at everything. I was sponsoring everything. I was trying to get into, not trying to, but I was very present and contributing to CCAR, WCR, Metro Tex YPN, all the different realtor and affiliate groups that I could get into just to make connections and learn what was important to them, what topics were they talking about. I was not scared to ask questions like, what's working for you? What are your challenges right now? And in that way, I kind of had an idea of what hurdles can I help remove? And I'm a strategy gal. I'm tell me a problem, and I'm going to tell you 6 ways we can fix it. So that's early on. I was always at events, always at coffees and lunches, always at networking things. And then I decided at some point, I'm spread too thin. I really need to, instead of having so many high-level, shallow relationships, I need to figure out who I want to do business with and deepen those and focus all my attention there. And that ended up being a very good strategy for me. I really care about the people that I get to support, and I never, ever want to let them down. I carry a very big sense of responsibility, so they know they can trust me because I'm not going to let anything fall through the cracks. But yeah, so I've focused a lot of my marketing time, if you will, on my realtors, my close client base, so that they're always getting touches from me, value add touches, not here's a new recipe or here's what to plant in your garden this month. I want to give them financial stuff to make their life better, to empower them to make their money go further. And then I've also got a builder account that we work with and help support too, and that's been a good focus for me.
Gotcha. So in your experience, I kind of know from my experience, but I'm just curious, when a realtor is working with a client, how often are clients accepting recommendations versus knowing who they want to go with? I mean, it's probably...
Great question.
What do you see in that?
Oftentimes when people start talking to a realtor, they've already done something in terms of trying to figure out what they can afford. Sometimes it's self-help and they're just using Zillow calculators and stuff, but oftentimes they've at least talked to whoever they bank with, or they've seen somebody market on Facebook and so they've reached out to them. But the relationship piece and the word of mouth referral holds so much weight. So when agents, and same vice versa, right? If people come straight to me because of a personal relationship or because of a client that referred me to them, and I'm like, do you have a realtor? And they say, well, we've talked to somebody. I'm like, I get to work with a lot of realtors. I know the best of the best. Do you want an introduction so you can interview them? And I'm never told no. People want that, oh, if you trust them and you've brought me value, I want who you work with, because you get to pick from all these different lenders or all these different realtors. So I think it actually brings more value when the realtor can make that warm connection. And most of the time, I mean, the capture rate is incredibly high, over 90%.
Right. If they're exploring it. I want to back up a minute. So we have, from our long form content, so the YouTube videos, the Spotify, more experienced people, people that are in the industry are listening to that. But from the short form, which is really where we get a lot of views, the algorithm's picking it up. It's going to a lot of people who are interested, but not necessarily in this industry. So sometimes when we speak high level, it doesn't create content for those that don't understand the difference between lending and a bank, for example. And they're very different, very similar, but also very different. So if someone is looking to purchase a home, what's the difference between what you do and going to a bank?
Good question. Depository banks, people who open checking and savings accounts, people who extend lines of credit, personal loans, credit cards, you name it. Almost all of them have a mortgage branch. They would be leaving money on the table not to, right? But they don't necessarily hire or pay for talent to bring that business in. They sometimes can offer better rates. Honestly, I've not competed against a big box bank in a long time where they were more competitively priced than I was.
Typically not.
And they're not trained. They're not hiring. I got to be careful how I say that. It's just a different model. And I know for certain that our model works very well because we're a mortgage bank. I'm not a broker, which means I have full control. We process, underwrite, and close in-house. I do have some brokered product when we need something niche or different, which is nice because I've got kind of the best of both worlds. But our pricing is phenomenal. We're direct to Fannie Mae and Ginnie Mae. I know exactly what's going to work. We don't have overlays. So a lot of people have trouble qualifying at a bank because they want oftentimes a minimum 700 credit score, much lower debt to income ratio. So it's harder to qualify with them. The process takes longer and there's a lot more nitpicking in underwriting. With us, very common sense approach. Anything that Fannie Mae or Ginnie Mae allows, so conventional FHA loans, like whatever the guidelines say is good enough for us. We're not adding overlays to make ourselves feel better and lower our risk. So it's just a very different process. I mean, my calling card, my expertise is all about strategy. I don't send somebody a pre-qual letter and say, you can buy up to this much home. Come back when you've got a contract and we'll approve you. I'm like working backwards into what are you used to paying for housing right now? I want to know what you're used to. And then I want to know what you have decided from a budgeting perspective your max comfort level is with a house payment and how much cash you have to spend. And that's what I need. I need to know your max payment and your max cash, and I will work you backwards into what price of home you can comfortably afford. I think a lot of people, you probably hear this too, people want to know, how much house can I buy?
Right.
Irrelevant.
Doesn't matter.
You can almost always buy more than you're going to be comfortable with, and I'm not going to set you up for that. So I always want to know, how much are you comfortable spending, and let me show you how much house you should be buying.
What are the typical things you're looking for somebody who wants to purchase? What are the things they have to have in order to get qualified?
You would be shocked to see how easy it is for almost everybody who is renting can buy a house. And I think that so many people have mental hurdles because they have been told or they think that you have to have 20% down saved up. You have to have over a 700 credit score. You have to have over 2 years in your job. Like they've created all these mental hurdles for themselves when really we want to see that you have stable income, whether it's self-employed or W-2. We want to see that you have a healthy-ish relationship with debt you have borrowed. So credit scores don't have to be fantastic. Frankly, we can go down to 500 on an FHA loan. That's a low score. So it's not that they have to be like the highest caliber. It's just what is happening on the trade lines that's on the credit report. Are you just behind on some payments, or do you let everything go into collection and charge-offs? If you've got any like housing debt on your report, how did you treat that? Because really everything is just, it's a game of risk. And we're trying to figure out what is the likelihood of this person being able to pay back the amount of money that they're borrowing in a timely fashion.
Sure.
If you just wanted to boil everything down, that's it. So we look at things like, what's your employment situation? How much money do you make? And if it's variable, what's a reasonable average that we can assume you're going to make based on the last year or 2 years? So it's a really holistic approach just to make sure that we're not setting somebody up for failure, because you don't want somebody to go into foreclosure or bankruptcy.
Sure. And it's also not necessarily, like, I think you hit on this, but it's not just based on how much money you make. It's also how much debt you carry too.
Exactly.
And so that's important when purchasing a home, is you got to be careful about the debt that you have and not adding to that in the middle of the process.
Definitely. No, it's best if you don't add new debts during a home purchase process. It's not necessarily a deal killer, but it's always best to ask somebody before you make a big purchase so you know what the impact's going to be, if any.
And what's the typical debt to income ratio that we're looking at?
It depends on a conventional loan. You can go up to 50% debt to income ratio, and people don't even know what that means. So a lot of people say, I only have, $6,000 in credit card debt, and that's it. I don't have a car payment. I don't have student loans, blah, blah, blah. And we don't care what your balances are. You could have $200,000 outstanding in debt. What is your minimum monthly payment that you're required to spend on those versus your monthly income? So we're looking at payments versus income. We don't care what the balance is.
It's not the collective total. It's broken down per month.
Exactly.
So how do you calculate debt to income?
So you take the minimum monthly payments on anything reporting to credit, plus the house payment projected for what we're trying to qualify you for, and you divide that by the monthly income that the person makes. And it's gross monthly income. So you can go up to 50% on conventional, up to 57% on FHA. Nobody should be doing that. You're going to feel tight. You're going to feel what I would call house poor. Yeah. And that's not the goal. That's why I always am working backwards into what's comfortable for you, and let's shop for that amount of house so that you don't hate me 6 months into your mortgage payment. I want you to feel empowered by this, not strapped by it.
Right. Okay. Makes sense.
Yeah.
So what are you currently seeing? So you being in the industry now for 10 years is very beneficial because you've seen
a lot
ups and downs.
Yes.
There's different cycles. We had the refinance boom in 2021. It was
20 and 21.
20 and 21. What are you seeing right now? What are things looking like?
Things are volatile. It's really exciting. I think so high level, interest rates follow inflation and recession cycles. Okay. You look back all the way to the 60s and 70s, and you can see, when we've had inflation, rates go up. When we've hit recession, they go down. It's very closely linked. So at the macro level, so I don't lose anybody and get in the weeds, they follow those two trends. We have been in an inflation cycle for years, and so rates have been high and volatile and very reactionary to every little news report, Fed decision. So there's a lot of analysts, we've got a lot of reports that show some recession indicators. Some analysts say that we're already in a recession. We just haven't called it that yet. I'm not an economist, so I'm not going to weigh in on my personal 2 cents, but I do think it's very likely that with the softening economy, we're going to see the rates come down. I don't know how far. I think that even if we just get under 6%, it's going to be a big deal for folks. And people that have purchased in the last 3 years are going to be refinancing their loans. And then it's also going to bring a whole lot more buyers to market, people who have been sitting on the sidelines waiting for more affordability. And there's pros and cons to that approach. Right. But yeah, I think it is very likely in the next 12 to 24 months, the rates environment is going to be much more attractive than it is right now.
So over the last 3 years, what have you seen the rates be? So if they get under 6, so they get into the high 5s.
Yeah.
Are people, if you bought from, call it late 2022 to today, what was your rate looking like?
Anywhere from 6.5 to 8.
Okay. So if you're in the sub 5s, saving 2% on a refinance makes a big difference. Yeah.
Some people start looking to refi as soon as they can save 0.5% in rate. I don't personally love that model. I want a really quick break even, so I'm always looking for at least 1% improvement in rate. But yeah, we're going to have a true refi boom for anybody who purchased in the last 3 years as soon as we get under 6.
And what does that break even? So if somebody's listening and they're going, okay, I got a 7.5% rate, when is that break even number? How do you determine that?
It depends. It kind of depends on what the near term outlook is. So if we're looking at things improving for rates in the next 2 years, you want to make sure you're going to break even really on rolling and closing costs and refinancing within that time period, because you may end up refinancing again. I refinanced twice. I did it in 2020, and then rates continued to trend down so much that it made sense to do it again in 2021. And, I ran a lot of analysis, and I do this for every client when they're like, should I refinance? And I always will show them, here's what it would look like. Here's how much we're saving monthly, but here's how much we ate into your equity to roll in the closing costs. That would give you a break even of about, 18 months or 2 years, whatever the number is. Mm-hmm. And then I'll give them just some anecdote of, I think that we've got more benefit down the road. So you can either plan to refi now, knowing you may refi again, eat into your equity again a little bit to do so, or we wait and we try to time it to where we're towards the bottom of where the rates are going to be. You know what I mean? And then refinance. So it really just depends on people's goals. And another thing people don't take into consideration when they're refinancing is how soon they're planning to move. Because it feels great to have a good rate.
Right.
But if you're going to be moving in the next 12 to 18 months because you're having a baby or you're chasing a job or a school district, then it doesn't really make sense. Because even though it feels better on the monthly payment side, you're giving up the equity you're going to get out of the house when you go to move.
So talk about that. So what does that mean when you're giving it? So again, we have to balance high level talks and low and not low level, but just there's a lot of people that don't understand any of this. So what is a refinance, and what are you talking about when you're talking about giving up that equity?
Yeah, sure. So a refinance is just an opportunity to reset your loan terms. So if you've been in your home a couple of years, and let's just say you did buy in 2023 and your rate is 7.5%, and you're seeing that rates are now closer to 6.5%. Mm-hmm. You can refinance your loan, and it resets your loan term back to the full 30 years. If that's the most common loan time, so I'll just use that example. But you get the lower interest rate, and there's closing costs. Similar costs to when you purchased your home are part of the refinance. 98% of people roll in closing costs into the new mortgage we set up instead of paying them out of pocket. So most people don't pay anything to close a refi. But when you're doing that, you're basically borrowing some of your equity stake in the property because your house value has been going up. You've been paying your mortgage down. We're resetting your mortgage, and you're going to add a little bit to it. So now you have less profit left over when you go to sell your home if you're rolling in the closing costs. But it improves your monthly cash flow, notably, when you refinance. So if you've paid down, but a lot of people bring, so let's just say you bought a house in 23, mm-hmm. you put 10% down. Mm-hmm. I mean, you're going to have closing costs, but you're resetting your loan at a smaller amount too. True. Right. Yes. So but it's where maybe not as much is put down, and you haven't been in it long, and you refinance, and so now that's added. It could make it to where you're giving up some of the equity that you've built. Yeah. And annual appreciation, 20 and 21 were astronomical. If you add those 2 years together, house values increased 40%. Yeah. That was not sustainable. No. That was a very interesting market. People ask me sometimes, do you wish we could go back to that? I'm like, no, because a lot of my clients didn't feel like they could win. You had to throw money at homes, overpay for homes just to have a shot at them, because every house had 8 to 15 offers mm-hmm. in a day. Mm-hmm. And that was hard on the agents. It was hard on the buyers. And for first-time buyers who you're trying to equip to go and do this, they're like, we don't have cash to throw at it. So they just felt like they had to sit it out. So it's harder because it feels like we've been in this high interest rate market for so long, and affordability is a real challenge. But it's a healthier situation than it was back then, yeah, for sure. And I definitely have encouraged so many clients who are they're on the fence. They can't decide if they want to keep renting or if they want to buy something because it's so expensive. And I really push on them and try to impress on them, you will be so much happier a year from now if you buy today, and then you have this appreciating asset. So the house is increasing in value. You're paying what feels like rent, but it's going towards something. And then you have money. You didn't have to earn it. You mm-hmm. have this asset that's increasing in value. And the last couple of years, the average appreciation has been 4% year over year. That adds up in a hurry. Mm-hmm. That's a great return for your housing. And that's what I try to remind people, you can go back and reset your loan terms via a refinance down the road as your house has increased in value. But if you wait till rates come down and all these other buyers decide that it's more affordable now, so they're going to enter the market, then you're in a competitive situation on every single house, and you're going to pay more for the same house. You're not going to be able to negotiate seller concessions. It's going to be a very different, way less enjoyable process for you, and you're not going to get as good of a deal. Mm-hmm.
Yeah. So where do you see, nobody knows, but where do you see things going? Call it 26 and 27. What do you think things are going to look like?
It's hard to say. I mean, analysts are saying 26 should be a great real estate year. I honestly don't listen much to forecasts beyond that because they go and revise them all the time.
Yeah.
So it's really hard to say that far out. But I can say from my 10 years on good years and bad years of the economy, housing has been very stable. People ask sometimes about, do you think we're in a housing bubble? Is the floor going to fall out? And, they're referring to the 2008, 2009 housing crash.
We'll never see. Yeah. Well,
no, you're right.
It's totally different.
It's completely different because the financing products are not nearly as creative and questionable. I mean, the reason there's so many constraints around what we do now in my seat is because of that, to prevent that from ever happening again. But you've got, especially in like the DFW market, we have such a healthy balance of housing supply versus people who want to buy a house. I mean, it's still part of the American dream. Every single survey says it. People want to own homes. They just don't know if they can. I feel like people are scared to even have the conversation. It's like, we are not attorneys. Like, you don't pay us by the hour. Like, just explore. There's literally, it is risk-free. We even do a soft look at credit. So for people that are curious, I'm like, feed your curiosity.
Yeah.
Let's have the conversation. Let's talk budget and see what numbers look like. And then you'll at least have a data point to decide, oh, I can do this. I want to do this now.
Yeah.
Or, okay, I have something to work for over the next couple of years. But either way, you've educated yourself.
Right. What do you think? Well, I think a lot of people might not know that, interest rates are something you can shop around in the industry. So what would you recommend from that standpoint? And, how competitive are you guys when it comes to that?
Good question. I think it is smart to talk to more than one person when you're planning your biggest financial investment of your life. Why not?
Sure.
Right? And it's pretty easy to do so. I wouldn't talk to too many because when you start talking to more than 2 or 3, it becomes noise and it becomes overwhelming.
Yeah.
But if you can get a referral is definitely the best way. Like, figure out somebody who works with lenders and who do they like to work with. That's always a good way to do it instead of picking somebody off of the internet or off of an ad. There's all ads on our feeds when you're on the Weather Channel or Zillow or, XYZ, Realtor.com. I think referrals are much better because somebody's had one or many great experiences with them.
Sure.
But talk to them, see what they put together for you and where you feel most comfortable. Like, who do you trust to guide you in that process? Rates are very important, but Barry Habib, he's an analyst and brilliant mind for everybody in the mortgage industry. And he always says, a great rate with the wrong strategy is a bad investment.
Sure.
Because there's not just one way to approach what we do, and you need somebody to take the time to educate you on what are the financing options and what is the difference in strategy, and should I be spending money buying down my interest rate? Should I do a permanent rate buy down or a temporary rate buy down? I have 20% down. Should I put that down, or should I put 5% down and pay off my car or invest with the other 15%? So it really matters to work with somebody who's going to take the time to educate you on how you can spend your money so that you have choices, because people, like most people, don't know how to look holistically at their budget and at their portfolio of assets. And some people be like, well, I don't have any assets. Well, you got a car lease. I'm going to call that an asset just because you're making payments on it, right? You're spending money on that. You're spending money on your credit card. Well, I don't carry any credit card debt. Yes, you do. I get to see your credit report. It's crazy how many people come to me and just say, I'm going to have nothing but my house. I'm like, you owe on all these things. That counts.
Yeah.
But they budget in buckets. So they say, okay, I know I have to spend $300 a month on my credit card payments. I have a $600 car payment. I've got these student loans that are in repayment now. So they've kind of budget how much money they have for each thing. And then they say that leaves over X dollars for my house payment. I have the opportunity to look at all of the debt and can help them figure out like where they get the biggest bang for their buck monthly cash flow wise and spending the money different ways. And I show them that.
And that's what somebody that's good in your role should do.
I love it. I'm a counselor. I'm not a salesperson. I would be a
Right.
terrible salesperson, but I geek out on the numbers because I'm like, let me show you how you can spend your money. And people are like, never even thought about that.
Right.
Especially people that are buying and selling at the same time. They're like, I just want to dump 100% of my proceeds from the sale of my home into the new home to get the payment as low as possible. Like, cool. Here's what that would look like. An alternative would be, let's put this much money on the house and then wipe out all this other debt, and you're going to save yourself $2,000 a month. And they're like, oh my gosh, I didn't even know that was an option. So
That's really cool.
I love doing that. Like that fills my bucket to be able to do that for people. That's why I said earlier, it feels like a calling because I'm like, I can't wait to see what you look like on paper because nobody looks the same. You know, everybody's situation is different. And I didn't answer your question. You asked me about how competitive our rates are. Our rates are very competitive. I've got a lot of flexibility in our pricing, but then also I think a lot of people, two questions I get asked when people call me for the first time, whether they're like kind of a cold calling in or if they're referred to me, they ask me, how much can I purchase and
What's the rate?
what's your rate? And I don't think they understand that we have an entire rate card for every situation. So just to like kind of simplify and visualize this, if the rates are from 6 to 7% and they go in eighths, so I can present somebody 7, 6.875, 6.75, 6.625, on and on all the way down. So when people ask what my rate is, I'm like, it depends. What loan strategy are we using? What is your credit score? What's your down payment?
Sure.
Are you buying down the rate or are we taking the free interest rate today? Like there's so many factors that go into it. But I can present them a number of rates, and I feel like a lot of lenders are nervous and have been the last few years because of how tough it's been.
Yeah.
That they'll just throw out a number. They'll be like, oh, our rate today is 6.25. That sounds really sexy, but how much are you paying for it?
Right.
You know what I
Right.
mean?
Right.
And so I don't do my business over the phone. People try to corner me sometimes into saying, like, what's your rate? I'm like, let me send you estimates. Let's look at itemized estimates, and I'll show you more than one. And it'll have an interest rate, it'll have an APR, and a full itemization, and it'll be very accurate. And then let's talk about rate
Right.
because it's not there's not one rate, and it's not a one-size-fits-all. It's really what are your goals, and how much cash are you prepared to spend, and how long are you going to be in this house, and how long are you going to hold this mortgage?
Yeah.
So it's
good
way more
questions.
consultative approach than just throwing out an interest rate because I can throw out any rate I want to. I could tell you I have 5.99. But you're going to pay for it.
It's probably a 15 year. So, okay. And I think that's really smart. The free rate, that moves daily.
Yes, every single day
Based
the
on
rate
the
card
bonds,
price
right?
is different. Yeah, so you might have the same general set of rates. Let's use that like 6 to 7% on conventional. I might have those same 10 rates, but the cost associated with each rate will ebb and flow every day. So like one day 6.75 might be the free rate, and then the next day it might be 6.875, and then back to 6.75. Like it ebbs and flows based on a ton of different inputs. Obviously, like jobs reports, inflation reports, Fed meetings and decisions. The tariffs showdown we had in April was a major market mover because people got nervous. So there's all different kinds of things that can impact the rates, but they generally ebb and flow within a range until something drastic happens, like when the Fed starts playing with the Fed funds rate, or we have a jobs report bust or stuff like that. Then we might see that little tight range shift down or shift up.
Okay.
So it's kind of cyclical. But again, if you want to like, when you're zooming in, there's a whole lot of movement. When you zoom out, you're like, oh, the overall trend was up with inflation and then down with recession.
And as of today, and it'll change by the time this episode goes out, but what are we looking at right now?
6.8 is about the average rate lock for conventional loans per Mortgage News Daily. I like using third-party sources just to give a general. People can look this up themselves any day. They update it daily. And then on FHA, it's about 6.2 average rate.
That's pretty good.
It is, yeah. And FHA is easier for people to qualify for. They're more lenient on credit score, debt-to-income ratio. There's a lot of benefits to both, but it's
Why would you not do FHA versus conventional?
a couple of reasons. One, if somebody's married and their spouse has poor credit habits, on FHA you always have to include a spouse even if they're not on the mortgage. You have to include their debt load, so sometimes that's challenging. FHA also, the mortgage insurance is
Higher.
set.
Oh.
Regardless of if you've got a 780 score or a 600 credit score, you're paying the same monthly mortgage insurance. On conventional, even though the interest rate's higher, if you have great credit, the mortgage insurance is super cheap because it's risk-based pricing for the mortgage insurance. So there's just some little differences. In a high interest rate market, I'm always just looking for what's your cheapest cost of financing, knowing that we're going to refinance you out of it anyways.
Yeah.
When we refinance people and I'm trying to set their loan terms for the long haul, I'm trying to get them onto conventional money because even if there's still mortgage insurance, it goes away.
At 80%, right?
Yes.
So with FHA, it stays?
Yes, until you refinance out of it.
Okay.
Yeah.
Okay.
Yeah. So there's pros and cons, and there's also, I feel like if I could just have a soapbox for a minute, I feel like there's 3 main mental hurdles that people have that keep them from trying to buy a home. One is credit, one is cash, and one is employment situation. And I just wish that people understood how malleable credit is. It does not scare me. There is no scored person that, even a no score, if they have no credit, everything can be fixed, improved, changed easily and usually quickly. So when people are, tell themselves they can't afford to buy a home because they don't have good credit, yes, you can. Let's build out a plan. And I've got awesome credit simulation tools that help me tell them exactly what to do and how long it's going to take if they follow my guidance. Super accurate. And then the other big one I feel like is cash. Mm-hmm. People are cash strapped. We've been sitting for so long in such a tough economic situation that credit cards are maxed out. Savings is at an all-time low. People don't know how to get out from under their credit card debt. And they're like, I don't have enough money to put down to buy a house. And there are down payment assistance programs that are phenomenal. Some let you make up to $135,000 a year and still qualify.
Really?
Yeah. So people think that you have to make very little money to access programs or you have to be a first-time buyer. Neither of those are true.
What is down payment assistance?
So there are programs, lots of them, that offer, they're kind of like nonprofits or government run, and they're trying to get people into home ownership. So they have pools of money that if you fit inside their parameters, which are quite flexible, they'll give you cash towards your down payment and your closing costs. I work with several programs. I have 3 that are statewide and then a couple of others that we've picked up along the way. And the ones that I like the best in terms of structure is they're silent second liens. So these, if you fit in the box to be able to use down payment assistance, they'll give you money towards closing, and it's a second loan against your property behind your mortgage. Silent means it's 0% interest, so you're not paying on it, and they're forgivable. So once you get to your 3-year closing anniversary, whatever amount of money they gave you is forgiven.
Wow.
You never have to pay it back.
Wow. So there could be a chance where somebody doesn't have to pay anything?
Correct. I actually had one literally close in April. I used down payment assistance, and we negotiated with the seller. I say we lightly. It's the agent, not me. But I told them, max cash spend for these folks is $2,500. That's all they have to spend. If we get in a situation where we can't negotiate something with the seller to cover the closing costs, it's no-go. And they got in and got 100% of their earnest money back. So FHA buyer buys $330,000 home, $0 of their own money to get in.
Yeah, so there's a lot of myths out there that aren't necessarily true.
Totally.
Yeah.
Lots of them. And it creates mental hurdles for people where they're like, it's not even worth me having conversation. I'm going to be wasting somebody's time. No. Almost everybody can afford to get into a home.
Yeah. Wow. Yeah, that's a lot to process. I got a family member of mine that needs to hear this. I'm going to send him this episode.
For sure.
He's looking to buy his first home, and his issue is cash.
Yeah.
So I'm glad you addressed that, and that's going to make great short form content right there.
Good. It's intimidating. I mean, I feel like a lot of people are intimidated by it, and they think, they picture bankers all suited up looking for people that have all their ducks in a row, and that is not most of America right now. Mm-hmm. And people come to me and they tell me, I'm so embarrassed. I don't want you to see this, but I know you're going to see it anyway, so I have to tell you about it, what you're going to see on my credit report. It's just like, you're not on an island. Like this is not exclusive to you. Everyone has their challenges and they all look a little bit different, but as a whole, our nation is in debt, a lot of it. and things aren't pretty, and that's okay. It doesn't mean you have to put your life on hold and feel shameful about it. Like, get yourself into a position to like make a change, and we can help with that. And that's what I love about my job.
Yeah, that's great stuff. So it seems like you have worked really well with realtors, and I know that that's vice versa for some people. What would your recommendation be if you're either a lender or a realtor listening to this episode on building a relationship with each other and the value that we can provide each other?
I think it's mission critical at this point with how nervous people are and how tight things are for folks. I find somebody or a couple of people that you work really well with, that you trust and that you know bring specific value to your mutual clients. For me, that looks like strategy and consultation. I want to work with people that do the same style of value add. I want people to be educated. I want them to be empowered with information so that whatever they're doing, they're making informed decisions. I don't like surprises. That's just how I'm wired. I even asked you before this, I'm like, what kind of questions are we talking about so I can plan? I'm a planner. And you're like, we'll just go with the flow. I'm like, okay, I'm okay. I need a brown paper bag because I love to have a plan.
Yeah.
So I have, found people that appreciate that, and it means that they don't have to worry because they know I'm super structured, and finding other people that work the way you do, or if that's not your strong suit, find people that plug that hole in your ship, you know?
Yeah.
But those relationships are invaluable because if everybody has the same information and expectation going into a transaction, you get happy clients, and the clients refer both of you for years to come. I get referrals from clients who were like third removed, but they heard through the grapevine that, I was able to do XYZ for them or show them different ways they could improve their cash flow across the board for all their debts. And like, that's the biggest reward in all of this, right? So finding people that work the way you do is invaluable because you're making like lifelong partners and friends, people you want to do business with, and you continue to be referred as like, it's almost like you don't know where one person's value ends and the other begins because it was your team, your real estate team. So I think it's important having those.
So if you're a first-time home buyer listening to this,
yes,
what's your message to them?
You can buy. Don't let your own fear or your own assumptions be the reason you don't start the process. Get into a home, even if you have the bare minimum to put down, even if it feels like a little bit of a stretch for budget. The money you're going to make on the house value appreciation is astronomical in comparison. Did you know, and I guess this is a good thing to kind of end with on that topic for first-time buyers. The Fed came out and said people that own homes versus people that rent their whole life, homeowners are 40 times more affluent, more wealthy than people that rent. 40 times. And that's the Fed. That's not like Yahoo saying it.
Right.
Like, this is factual stuff. If you want to build generational wealth for your family and for your future, you've got to own property. And one other thing I would say to first-time buyers is you don't have to be wealthy to be an investor. I think that that's also a myth. People think that you've got to have 20, 25% down over and over to build up a rental portfolio. You can do it 5% down at a time. Did you know that?
No. How?
Check this out. So if you're buying...
tell me how.
Yeah. If you are buying homes, primary residences, putting 5% down, and you just decide, I want to have 5 doors in 5 years. Literally, buy a home, 5% down, 12 months later, you've been saving up over the 12 months to have another 5% down, go buy another primary residence, rent out your old home. Rinse and repeat 5 times.
Yeah, okay.
Every 12 months, 5% down, keep the old home. It is an awesome way for young people to be able to build up a rental portfolio without ever having to spend 20% down to do it.
Yeah, wow.
And the other cool thing about that is you never have to have investment rate pricing. So interest rates on investment properties are way more risk-based, yes, than primary house rates. So if you're always buying yourself primary homes, they're on primary home interest rates. It's awesome.
It requires moving
It does. It's got to be a plan. Like, you got to
having
choose.
a spouse that's okay with doing that. But yeah, that's a great way to house hack.
Yes.
Well, we're out of time.
That goes fast.
Easy enough. I told you it would.
Yes.
How can people find you?
My website, laurenstamper.com, really hard. On Facebook also, they can search Lauren Stamper. There aren't very many of us. And I always tag my business page through there. So if you follow me personally, you'll find my business stuff. But
Perfect.
Yeah, that's about it.
Cool. Well, I appreciate you having on.
Yeah, thanks for having me. This was fun.
Yeah, cool. Anytime.